Hey, how you doing? This is Adam Post, publisher of more than 1,000 comic books, and I've been covering Disney very closely. Disney's in some serious trouble. So financial analysts are in the business of rating a company and judging, is this a good company to invest in? Yes or no? Well, one of the companies who was evaluating Disney, who used to be a big supporter of Disney, has decided they do not trust this stock and are recommending you kind of better not buy this stock right now. Coming from Hollywood Reporter, Disney analyst has downgraded the stock due to, quote, risky streaming subscription forecasts and their deteriorating linear TV business. The linear TV business are their cable channels, where they're losing subscribers for cable and they're losing advertising revenues. Wolfe's Peter Supino moves from an outperform to peer perform rating, citing cognitive dissonance. When he says outperform to peer perform, outperform would be saying they are better than their peers, the other companies in the entertainment business, and now they're saying not really. Even though, of course, they should be, because Disney has this 100-year history. They have the theme parks. They have diversified ways of bringing in money and tons of intellectual property. And while they have debt, it's not as bad as some of the other entertainment companies. Warner Bros. Discovery has a large amount of debt, but still, this is not a better than average company anymore. And this analyst, Peter Supino, used to be a big promoter of Disney stock. When he says cognitive dissonance, this is what he's talking about. The mental conflict that occurs when your beliefs don't line up with your actions. So Disney is making statements that don't fit what they're actually doing. Let's get into this article. Before we do, please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up. Really appreciate you guys. Walt Disney shares got hit with a downgrade on Friday, with Wolfe Research analyst Peter Supino seeing cognitive dissonance taking the spotlight from the Hollywood conglomerate's traditionally touted Disney magic. The magic is gone. Quote, the theme park's growth, cost cuts, and direct-to-consumer average revenue per user growth we forecast are in consensus, earning estimates, while the direct-to-consumer subscriber and linear TV outlooks keep deteriorating. Direct-to-consumer plans, and this is the Disney Plus, Hulu, ESPN Plus, for more subs, higher prices, and lower costs seems like cognitive dissonance. Supino cut his fiscal 2024 operating income projection by 5% and changed his stock price target from $133, which is very far away from where Disney stock price is now. It's at $91.99. And if you look at where it is over the past 5 years, it's actually down 11.5% from 5 years ago. So your return would not be very good if you've been holding Disney stock for the past 5 years. And they've changed their price target from $133 to NA, not applicable, basically saying, we have no idea what the price is going to be of this stock. Disney CEO Bob Iger and his team have said that they've started a broader refocusing of the entertainment giant, but more work was needed. Quote, with Disney Plus subscriber forecast looking risky, the linear TV outlook deteriorating, $2.5 billion of hard cost reductions now in consensus, and content amortization set to catch up to cash spend in the coming years, we downgrade Disney to peer perform, he explained. What he's saying there is, it doesn't look like their subscriber growth is going to be good for Disney Plus or their other streaming services. They recently announced they lost 4 million subscribers this quarter, although a lot of that was in India, but 300,000 of it was in North America, where people pay a good amount of money for the subscribers. And to keep in mind, it's not just that they lost 300,000 subscribers. They spend money on getting new subscribers all the time. The net result was they lost 300,000 subscribers in North America. So they acquired subscribers, they lost subscribers. The total lost versus the total acquired was negative 300,000. How many did they really lose? Obviously more than 300,000. It's netted out against the ones that they gained. With respect to the content spend and the amortization, what they're talking about is the money spent on new content, TV shows, movies, versus their amortization, which is the years that they spend writing off the cost of the stuff that they make, is about equal. In fiscal year 2024, we expect less advertising and affiliate revenue, less $500 million, and less direct-to-consumer revenue, $1.1 billion, with around 80% related to lower Disney Plus subscribers. So the revenue is going to be a lot less than expected. We see scope for additional cost cuts, integration of Hulu into Disney Plus, international direct-to-consumer shutdowns, ESPN international sports rights, and selling general administrative cuts. But highly incremental margin direct-to-consumer revenue growth is essential to Disney's stock multiple, and we're increasingly skeptical. So what he's saying is this. Yes, there are plenty more cost cuts to come. I always say that on my Disney videos. They are going to lay off many, many more people. if they do consolidate Hulu into Disney Plus, which it looks likely they will do, they will have more layoffs on top of that. And that will save them some money. But the thing that makes the business work is being able to get extra subscribers to their streaming services. If they can't get extra subscribers, they're going to have severe profitability problems. Because the extra subscribers, they can service those and it's almost all profit. It's almost like when we publish comic books. When we sell a couple of extra comic books, the cost to print those is very little. It's the first few that cost a lot. But the problem is, if your sales go down and down and down, or if it costs more and more money to get or keep a customer, you're not going to be profitable, and that's what this guy's warning against. That said, Supino highlighted that after an 8.7% drop in Disney shares on Thursday, when several analysts cut their stock price targets following its late Wednesday quarterly earnings report, he expects valuation support thanks to strong parks and cost reductions trajectories. So after the quarterly report on last Wednesday, a lot of analysts cut their stock price targets for Disney. They did not see a good future for Disney's stock price. You know, Disney has made a lot of suggestions that they're going to be changing and restructuring how they do business. And these are good suggestions they have. I agree with a lot of them, and they do make a lot of sense. The biggest problem they have is the Bud Light problem, that they've damaged their brands. Disney hasn't addressed that yet. At some point, it's going to come up. As Marvel does less and less business with their films, as Star Wars is not considered to be a franchise people are excited about anymore, at some point, it's going to come up. These analysts are going to rediscover that, hey, why are so many of your fans angry at you? Why is it that supposedly there's this review bombing that's going on where Peter Pan and Wendy, the live action remake on Disney Plus, is getting the worst ever audience score? Why? Why are people review bombing you? They just hate Bob Iger? No, because they don't like all the social justice changes that you're making, and it's not necessary for good content. It's not necessary for distribution. It doesn't please consumers. Now, Rotten Tomatoes is helping Disney out. They're even going so far as to hide what they consider to be review bombing. So for the people that don't like Peter Pan and Wendy, they don't like how it's being marketed and promoted. They don't like that the Lost Boys are now also girls. Very strange. Rotten Tomatoes is going to help them cover for it. But at some point, this is going to come up just the same way that it came up with Bud Light. It's only a matter of time. It makes the stock actually really, really risky because unless Disney addresses this with their franchises, they're going to have serious problems. Again, while they've made some good decisions in terms of adjusting their costs and restructuring, none of that is because they're competent and they're making good strategic moves. All of it is duplicating what David Zaslav and his team came up with at Warner Brothers Discovery. For example, focusing on making the streaming services profitable, making them an actual moneymaker. That's something Disney's been talking about, well, only after they did it at Warner Brothers. Focusing on profitable subscriber growth for the streaming services, not just getting subscribers at any cost. Reducing the amount of new content for their streaming services. Removing content from the streaming platforms to take extra expenses and charges for content that people aren't really watching. Disney just announced they're going to be doing a $1.5 to $1.8 billion expense, a charge, for doing exactly that. Disney is no longer going to be producing big budget films for streaming only distribution because it doesn't make any economic sense, just as they did at Warner Brothers Discovery. They're going to be combining Hulu with Disney Plus in one app. They're still going to offer them separately, but of course, it's exactly what they said they were going to be doing at Warner Bros. Discovery. Why is Disney doing it? Disney has said they're doing it for a one-app experience, so it's easier if you have both subscriptions to just kind of go through the two of them. But obviously, it's because they're going to market them together. The reason that Disney is doing it is, of course, the same reason that Warner Bros. Discovery did it, because it's cheaper to market one brand than it is to market two brands. And you get more revenue when you sell the bigger app than you get for selling one or two individual apps. David Zaslav already figured this out for Bob Iger. Additionally, raising prices on the streaming services makes sense. Again, there isn't this fear like, oh, we have to have some number of subscribers. They're just trying to make it profitable now at Disney, the same as they already did at Warner Bros. Discovery. Additionally, realizing that when they create new content, sometimes you can show it on the streaming service. You could also show it on other platforms. This is something that Disney is coming to realize after Zaslav has had so much success with it with Warner Bros. Discovery. Additionally, of course, the aggressive layoffs and consolidations, while Disney eventually was probably going to be forced to do that anyway, it already happened first at Warner Bros. Discovery. They were doing it before it was cool. So where this leaves Disney is in a position where Wall Street analysts are starting to warn you might not want to own this stock. We can't say a lot of good things about this stock. There's no public discussion yet that I've seen about how Disney could be the next Bud Light. And keep in mind, the situation with Bud Light is so severe that not only the Bud Light brand is getting canceled, where people refuse to buy it, but all the other brands associated with Anheuser-Busch are down 12%. 12%, it may not seem like a lot. It's a massive amount. With Bud Light, it's anywhere from 14 to 29% nationally. And that is only going to get worse because there's such a severe rejection of that brand. But it affects all the Anheuser-Busch brands. This is what's coming for Disney in the future. They are going to be following Warner Bros. Discovery and getting out of the woke business. That's what I really believe. That's my big prediction in seeing all of this. They've duplicated everything else that Warner Bros. Discovery is doing. Why would they not duplicate that? Except that Bob Iger obviously does not want to give in. He wants to continue to push his social woke agenda religion. However, eventually, I think he's going to get forced to do it. Let me know what you think, though, in the comments below. Are you surprised that financial analysts are now warning people don't buy this stock? Were you surprised to hear that with Bud Light, they had that problem where analysts are coming out now and saying, hey, you probably shouldn't buy this stock right now? Did you realize that all of these strategic moves that Bob Iger is making, they aren't even Bob Iger's? He's basically just duplicating everything that David Zaslav and his team did at Warner Bros. Discovery. Would love to see what you think. Really be sure to leave your comments below. Always love to see your comments. Please be sure you are subscribed to the channel. Click the bell for notifications, give me a thumbs up, and I'll see you again soon with another video. And if I don't see you, I will miss you.